I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. It's these two people for the first time in a few weeks. Brad, welcome back
Thank you.
from your European vacation. We're going to talk a little bit about some of your economic takeaways from your trip shortly, because you know that's the real reason you went there. But you went with your family. Uh, so you went to Greece, England, where else? Just those two countries?
Yeah, we went to Greece and England. We kicked off the trip with 3 days in London because British Airways was dead set on us spending at least 12 hours in London on like layovers and stuff to get to Crete. So we're like, all right, well, we'll just turn it into a 3 day jaunt. Saw Westminster Abbey, saw a play on the West End, British Museum, which was kind of cool because everything we were seeing in Athens and in Heraklion was stolen by the British and held in the British Museum. So we got to see like all the OG stuff and not just reproductions. Did 5 days in Crete and then did 3 days in Athens.
Sounds lovely. Yeah, I've done Greece, Athens. Sounds like you guys did. It was hot when you did the Acropolis, Parthenon. Uh,
E
Quite a hike, from what I remember.
Yeah, the we got kind of lucky with the Acropolis. We went over there. We're like, okay, well, we'll just get an early start. It's hot out. I mean, it's not like 100 and humid, but it was like 90s and humid.
Oof.
And our host, we rented an apartment there for a couple of nights. Inadvertently mentioned that there are timed slots to get into the Acropolis. We just figured we go over, we buy tickets the night before, and the slots had sold out until like 1 in the afternoon,
Yeah.
which would have been a nightmare because it would have just been brutally hot. But we were using this, we used this service called Get Your Guide to go to Delphi the day before, and they had basically pre-booked slots that you could just buy for what they called a self tour, but it was just like last minute buy early entry. So we did that. We paid the tourist tax for it because we were dumb, or I was dumb, and I didn't realize that there were timed entry slots, but it was a lifesaver. So if you're ever in a spot where you're like, hey, I need to go to the Acropolis at 8 a.m. And they're out of tickets until 1, check out those third-party services because that was an absolute lifesaver. And we paid probably 4 times what the tickets should have cost,
Yeah.
especially because the kiddos would have gotten in for free, but well worth the money to not be stuck at the top of the Acropolis at 2 in the afternoon.
Sounds like buying the Genie Pass when you go to Disney or whatever it's called.
Yeah,
Um,
pretty much.
yeah. Worth it. You buy those 5-minute lines rather than hour-long lines. Anyway, we'll get into your economic takeaways shortly, but tell people what else we're going to talk about today.
So we are going to talk about the market being up 20% in the last 2 months, whether or not that is going to portend good things to come. The tariff pause expiring in July, is that going to be another Liberation Day style sell-off? We're going to talk about cooler inflation, but the Fed still seems content to hold rates where they are. And silver finally sort of catching up to gold, although obviously the headlines overnight and today have reversed that a little bit. But before we get into all that, it is your turn this week to defend the hottest take that you can think of. Feels a lot less hot this morning, but a pullback of at least 5% is coming in the next month. You have 90 seconds and you may begin.
Yeah, I gave you this take yesterday when, volatility was low and all was clear before the Israeli strike in Iran, which is obviously prompting stocks to fall today, only about 1% as we're recording. But yeah, I think a 5% pullback, at least a 5% pullback is coming in the next month. Now that I think is with or without um, you know, deals or an extension of the 90-day pause, which expires July 9th, which we're going to talk about on the tariffs on 130 countries, pretty much everyone other than China and the UK, which the one country we've actually struck a deal with. But I think as we get closer to that deadline, there's going to be more angst, there's going to be more volatility, fear. And I think there's going to be some selling that happens, especially now that we're back close to our February highs in the back half of this month, and especially in early July if we don't make any progress. There hasn't been a whole lot of progress, despite a whole lot of words from President Trump, but it's just words right now, saying there's going to be all kinds of deals, but there are no deals right now. And you sprinkle in what's going on in Iran, Israel, that's more reason for volatility. I think we're getting a 5% pullback in the next month.
All right. Yeah. I don't know. The only like counter that I have to that is how seriously is the market going to take any of the tariff threats?
Yeah. It's
It's
different from last time where it's not all new. It seems like market knows how to handle um, tariffs and Trump's rhetoric around them. But I guess that's why I'm saying 5% and not,
no.
close to 20% like last time.
Yeah, it is so hard to try and like game that out when you've got more uncertainty in the market now because of the Israel strikes on Iran. It's just another like
Yeah.
outside influence. Okay, well, the market seemed to respond pretty well to the China deal that was announced, even though it still pins Chinese tariffs at like 55%.
Yeah.
Um, and then what the International Trade Court said Trump can't impose tariffs, but an appellate court overturned them. So there's going to be a lot of sort of back and forth. I don't know if the market takes the tariff thing seriously anymore. It very much feels like it got it out of its system after that initial really volatile sell-off and is now just sort of rolling with the punches. I mean, until last night, until this morning, it very much felt like we were at the wall of worry phase of the bull market,
Yeah.
where yeah, some bad news, some things aren't perfect, but the markets can tend to just sort of drift higher, even though
Yeah.
we hadn't quite gotten back up to those all-time highs. It still felt really bullish.
Yeah. And yeah, I do think the pullback will be modest. This is basically like the second part of a kind of a two-part take that I had back in April, which was buy in May rather
Yeah.
than traditional sell in May, because I thought, after the pullback, basically correct, not only correction, but bear market. Flash bear market we had in the NASDAQ and small caps in April that we were, due for a rally, and especially after the tariff pause was announced. So I said, buy in May, but I thought that as we got close to the deadline, the early July deadline, that, angst might creep back in. And I think you're right. It's not going to be anything like it was, the shock that it was in Liberation Day 1.0. Um, but
Should we just roll into the
yeah, let's roll. Yeah,
20% bounce? Let's roll
yeah,
into
yeah,
that. Yeah, so the Mike Santolo wrote about this a couple of days ago. I don't know if I haven't seen another analyst write about it, Cliff maybe. Um, but he was citing, let's see, who's the Twitter analyst? Ryan Detrick.
yeah,
20% rebound in 2 months, and it's only happened like a half dozen times historically, and every time it's happened within 12 months, the S&P has been a total of like 30% higher. So it very much, I don't know, that the buy in May thing, spot on call. So kudos there. Um, do we have more upside ahead? Are we going to just run into a bunch of like news that it individually is not enough to undercut the market, but in the aggregate is enough to
mhm.
stall us out here?
Yeah. I think while you're gone, I think it was while you're gone. I talked about that survey that goes out to a bunch of um, hedge funders,
The
economist
fund
types,
manager, Bank of
fund manager.
America fund manager survey.
Yes, and like the average was around what we'd finish the year. The S&P would finish the year around 5,900. So basically flat for the year, flat from when the survey was taken. We're up slightly since then. I said that I thought that sounded in the ballpark, give or take 100 points or so. I think 6,000 plus or minus 100 sounds about right. So I think there'll be ebbs and flows, and I think this could be an ebb in the next month with no obvious catalyst. coming other than, deals being announced with 130 countries.
Yeah, that I think the mention of catalyst I think is spot on. Like, okay, well, what really is going to be the driver to push us back above all-time highs and then higher from there? Um, I mean, I guess we've got next quarter's earnings season. We're
Yeah.
sort of limping into it right now. I mean,
Which
maybe if we
happens to coincide with the date, July 9th, with the expiration date. So,
Yeah, I mean, maybe if we get some really impressive profitability and good earnings numbers from, I mean, unfortunately, it's like Mag 7 or bust again,
mhm,
where like these individual companies are really not contributing meaningfully to dragging the indexes higher. It's all sort of pinned to the performance of big tech. But if we start seeing like impressive earnings beats, if we start getting some meaningful deals, like I can envision a scenario where those things are enough to sort of push it higher, but I don't see anything in the market that is as fresh and exciting as like AI was a couple years ago, where it's going to be like, hey, this is the driver, this is what gets people off the sidelines. So I think I'm largely with you, where it's like I think we rattle around for a while, barring some sort of like incredible news or unexpected development. We were already priced for perfection coming into the year, and things are very imperfect right now. So
right.
the bull market taking a little bit of a breather would not be unexpected to me. I would like to see it reclaim new highs. Obviously, that is a boost to confidence or a vote of confidence in the bull market. But even taking a breather around 6,000, if we can get bounce back and get above it again, um, strong but not perfect, strong but not great. I don't know.
Yeah, 61.44 was the closing high in on February 19th. We're now just below 6,000. We got to earlier this week, got to, oh, sorry,
60-50 ish.
yeah, 60.50-ish. Closed yesterday at 60 45, but that was pre airstrike. So we may have a few down days depending on what happens over the weekend. Who knows? Um, where do you want to go next?
I don't know. Do you want to go to Liberation Day? Do you just work through like the headlines and then we'll just go
Yeah,
grab the stuff at the end?
yeah. I mean, we've already basically talked about this. Yeah, so July 9th. I mean, like I said, I don't think anyone sees deals just being struck with all 130 nations that on which tariffs were imposed on Liberation Day. Um, what do you think the most likely scenario is here? Maybe a few deals, and then another 90-day extension with everyone else.
Yeah.
You know, courts actually successfully overturning the president's ability to impose tariffs. What do you think is the most likely scenario?
I would be I don't know. I'm trying to get a read on the Supreme Court is hard. Like are they likely to cap the president's authority when it comes to this? Maybe. I mean it
Oh, I
seems like
don't
a
know.
pretty it feels like a pretty cut and dry case to say, well, President Trump doesn't have the authority to unilaterally impose these levels of tariffs.
Mhm.
But that hasn't stopped them from ruling in ways that don't make a ton of sense to me before. I think the most likely outcome is, excuse me, is what we've been seeing for the last month or so. Kick the can down the road, talk up deals, try and do it carrot and stick, and like threaten imposition of even more reciprocal tariffs. Because didn't that happen in the last like 2 days? Didn't President Trump come out and say, if nobody's negotiating in good faith, we're going to hit them with even higher tariffs or bigger
Yeah,
tariffs?
yeah.
Uh,
And
the
what's
the
noteworthy is him saying that didn't cause panic in the market. I think so. It goes to your point of market maybe not taking his tariff rhetoric seriously anymore.
Yeah, I think that's exactly it.
Yeah.
I mean, there's the taco thing. I don't know. I saw headlines about that where the acronym is Trump always chickens out, and I think it was the Financial Times a reporter. I may be mistaken on the reporter that did it, but something has popularized that term. My apologies for not having a handle on it. I
I saw
have been
Stephen
out of the
King
country.
put that out there, and I thought he originated it, but probably not.
No, I think it was some. maybe a reporter for Fortune, somebody like that, somebody in the financial media,
Yeah.
um, which I don't think is entirely accurate, right? It's he's not chickening out and reversing tariffs. He is entering into negotiations, and then courts are sometimes telling him you can't do that, which I think is a minor difference, but is a distinction certainly.
Yeah.
But I do think that that is how the market is approaching it, which is he may or may not have authority to do this. He's going to talk a big game, um, and then even with the Chinese progress, like he sort of did the right thing in prioritizing rare earths. That was the choke point on imports. Um, in exchange, he gave Chinese access to U.S. tech, and he sort of held the new tariffs high enough to, I don't know, soothe his ego a little bit at like 55%. I think it's higher than they were, right? Like it gives him the ability to come out of that saying, "Hey, I raised tariffs. I played hardball." Um, and I think we get more of the same. I guess if as a block, other countries stop even engaging in good faith, then maybe we get some disruption from it. But I don't think any trade partner is incentivized to draw a line in the sand with this,
Yeah.
right? Like if you're willing to play ball and, give Trump some wins, then you can sort of get out of this unscathed. Happened with London, and all it took was a press conference from their prime minister and Trump. Um, right? You give him the visible win, the headlines, and
Hmm.
then he'll mostly leave you alone.
Yeah.
And I think the market is expecting that.
Yeah. And I think my expectation for volatility and a pullback in the next month, well, yes, has is partly to do with that deadline. I think also just sort of like you mentioned sort of the natural ebbs and flows of the market, which is sort of, as you said, priced to perfection right now, and there's so much going on out there that have threatened to drag it down that hasn't in the last few months. And I think now that it's priced this high, what seemed like um, not much of an obstacle after stocks had fallen nearly 20%, when they've all now recovered all of those losses, seems like maybe people might be looking for more of an excuse to sell, I guess is my point.
Yeah, that could certainly be the case. And I think one thing that will maybe be revelatory in the next month, a few months to come, is um, the best approach in my mind for trading partners to take is what people have been saying for a really long time about the president: take him seriously, but not literally,
Mhm.
right? Like treat the threats, even though they're kind of outlandish, as serious trade positions or serious threats, but don't operate under the assumption that he's going to impose the sort of worst of it. Is treat him with the respect of, hey, these are valid threats. This is a thing he can do. I guess where it would be problematic then would be if there haven't been a lot of negotiations, if trade partners are not taking him seriously or literally, and they're just effectively telling the administration to pound sand
Yeah,
or aren't engaging in good faith, right? Like we, as serious counterparties, we engage in good faith. The administration does not engage in good faith, but as long as you are doing what they expect you to do, I think you could make meaningful progress. But that doesn't seem to be the case. I haven't. It's not like people are ducking his phone calls.
right.
That would seem to be the bigger risk to me is if he's not gaining any kind of traction with the threats, and then the Liberation Day 2.0 hits, and he's very frustrated and says, "You know what? We're just going to double everybody's tariffs."
Yeah,
Like it, because that's the kind of response that it would engender with him is nobody's listening to me, nobody's paying attention. I have to raise the threat level.
right. Yeah. Okay, let's move on to inflation, which I mean that's we talked a lot about the difference between the hard data and soft data. Soft data meaning things like sentiment, consumer and investor sentiment were really low in April, May. I think it improved a little bit now, but still fairly low. Meanwhile, the hard data of jobs and especially inflation has continued to improve. And we mentioned earnings potentially being a catalyst, second quarter earnings potentially being a catalyst. That's coming off Q1, which the earnings growth was what, 13, 14%. Well, now inflation came in this week's, is that this week? Report 2.4%, I believe was the number, up just slightly from 2.3% last month, which was a 4-year low. Um, Month over month, it was, uh, what, 0.1, 0.2%,
Yeah.
something like that. And so the inflation, we're at the Fed's 2% level. I mean, not exactly, but you and I had always said once it gets below 3%, that's when they start cutting rates. Well, they did. And now it's been since end of last year that
Yeah.
they haven't cut rates once this year. But it seems like they're going to stick to their guns and no one expects them, almost no one expects them to cut rates this month. June 18th is the next Fed meeting. 97%, according to the FedWatch tool, CME Group FedWatch tool, think they'll hold rates steady in June. In July, end of July, that number is 77%. Think they'll hold steady. It doesn't flip to the majority think that they'll start cutting until September. What say you?
They don't need to cut.
Yep.
CPI at 2.4%, core CPI at 2.8%. Um, Looking at the numbers a little bit, gas was down 2.6% month over month. That obviously is going to be up in the air now with oil prices spiking almost, what,
Yeah.
10%, 9% higher
Yeah.
just today. Um, Shelter inflation was one that I circled as sort of an outlier. That was up 0.3%. Uh, but housing values are declining pretty much across the board. The consumer real estate market is sort of weakening a little bit. That was one place where I saw the opportunity for sort of longer gains in the inflation rate. The tariff price hikes hadn't really filtered down into anything yet. Who knows what happens with that? But like right now, the Fed is in sort of a let your winners run position where it's like, hey, they're at a good spot. Inflation is moving in the direction they intend. The employment rate is holding at, I think, what, 4.2%. We're not seeing a ton of deterioration in the economy. So we're just going to stay in a holding pattern and see how much success we can sort of wring out of this strategy. And it has been a ton. It's been a lot. It's been very successful for them. There's no impetus to cut. I don't, I've been very skeptical of the rate cut in June for a long time.
Yeah.
I don't see one happening. September, maybe.
It didn't seem
Um,
that long ago where people were expecting it. I'm looking at the FedWatch tool
yeah,
now
May,
where it says a month ago it was, still
60%, right?
no, a month ago is 91.6. So still, not as high, but still really high. I thought they'd hold. But yeah, I feel like I can't remember what flipped it so dramatically from the majority thinking it would be in June to almost no one thinking it would be in June.
I think we had some outlier jobs reports that looked better. Although
Yeah.
the jobs reports keep getting adjusted down. I think
Yeah.
like the net additions for jobs this year is actually only like 90,000. The labor market is not as strong as the sort of monthly reports would have you believe because of these revisions,
Yeah.
but the wheels aren't falling off.
No.
So the Fed doesn't need to like pull us into the pit to get our vehicle addressed because the wheels aren't coming off. Everything's fine. We're just going to keep running laps. I don't know. Did that metaphor
Keep
come
going.
across?
Keep going with the car metaphor.
Uh, and I'm the driver. I don't know. It's falling apart a little bit there. But no, like, all right, we're running good laps. We don't need service. We don't need fuel. Like the Fed's just going to let it keep running. Um, if we get a cut in September, it's going to be in response to something that happens. And given what is happening with oil prices, I can't imagine that they're going to cut because inflation is suddenly like sub 2%. If they're going to cut, it's going to be because of the labor market. Um, Although there are provisions. So one of the reasons for a lot of the job cuts in tech is tax treatment of R&D expenses, which
Hmm.
includes payroll for your researchers and your comp sci guys and your programmers and all that. Um, the Trump, the prior Trump tax bill changed how that was treated. So big tech could no longer just take a write-off for all their salaries. Um, the the big bill supposedly is going to restore that, and if they do, that'll be really good for jobs, assuming the big bill passes and it's got like all the elements in it. Um, if that stalls, then I think the tech job cuts sort of continue. Microsoft's been doing layoffs. Meta, Google, I think like all the big tech guys I think are doing layoffs.
Yeah.
Um, I think that'll continue if the big bill doesn't pass, but if it does, that'll actually sort of stem the bleeding in jobs a little bit. But barring some sort of unexpected cratering in the jobs market, I don't see a Fed. I don't see much impetus for the Fed to make like a rush cut, let alone a 1% cut like the president
Right.
has for.
And they're clearly not going to cave to what Trump wants them to do. He
Yeah,
just said he wants them to cut by a full percentage point. That's not happening. I think it became
ludicrous.
clear that I think they gained some leverage a few months ago when every time Trump kept saying threatened to remove Powell. What did he say at one point? Like his
Too
termination
late.
can't come soon enough.
Yeah,
And the market clearly hated that. The market did not want that extra level of uncertainty, especially considering the Fed has done a pretty decent job threading the needle here the last couple months. So I think he's sort of backed off a little bit, even though he's still saying they should cut 1% or whatever. Um, but it feels like they've tuned him out, which um, they're operating on their own, which is what they're supposed to do, and that's a good thing.
yeah.
Um, all right, let's move on to number four in our starting five, silver. So we know about gold. Gold is at right around all-time highs, and it probably is all-time highs as of this moment because of the flight to safety after last night's and ongoing bombing uh, in Iran. Um, Gold has done phenomenally well. Silver under the radar, but it's starting to play catch up. And one of the impetuses,
Impeti? My,
impeti,
my gut says impeti.
yeah, for that is as both colleague Carl Delfeld and I think Cliff Troke, the basically as the two guests I had on here while you were gone, Brad, um, both highlighted that a rare indicator flash of 100 to 1 gold ratio, gold prices being 100 times higher than silver. Gold right now is 34.59. Yeah, up about 1.7% today. That's $3,459 an ounce. Silver about $36 an ounce. Um, but silver's been playing catch up lately. It bottomed at $29 in April, back up to 36. The high point ever for silver is like $48 all the way back in 2011. So unlike gold, it's not at all-time highs. Um, and we've had a few analysts, and myself, I'll include myself in this, that have recommended silver stocks in the last few weeks with great success. What do you, how do you like silver as a play right now?
So yes, but all right. So just for some perspective, gold's up 29.4% year to date, 6.4% in the last month. Silver up 21.1% year to date, 9.4% in the last month. The 100 to 1 ratio is the only time in the 2000s since 2020, which was the pandemic sell-off.
Yeah.
One of my takes early this year was I liked silver to outperform gold, which at the time was premised on a lot of growth, right? Like silver is widely used in EV, it's widely used in solar, it's widely used in more tech applications, and it sort of presumed that take presumed that we wouldn't have the flight to safety element that we've had. And that obviously has not panned out thus far, and is even right now, silver I think is down on the day. It was when I checked before we started recording
Yeah,
this.
so about
Um,
0.5%. Yep.
and gold is up, I think, like 1.3%.
Yes.
So the flight to
1.7.
safety, the flight to safety with gold has definitely overridden any kind of growth and or any kind of growth moving from silver. What's the word I'm looking for? Momentum. Any kind of growth momentum from silver.
Yeah.
So we ran into that with tariffs. We're running into that with conflict in the Middle East. That valuation, that 100 to 1 valuation is like a huge green flag to acquire silver, especially if you think we get back to sort of business as usual.
Mhm.
If the Israel-Iran thing sort of peters out, and if tariffs end up just being more kicking the can down the road like we've seen. Like I like silver a lot. I liked it coming into the year. I thought there was room for it. Some of the macro conditions haven't been as supportive of it as I'd like, but
Up more than
obviously,
20%.
yeah, it's
That's underperforming gold, but still, that's been a good investment this year.
yeah, and I still like silver going forward, especially if we make meaningful progress with China and with tariffs, and if we can shake off the market fear
Yeah.
of Middle East conflict stuff.
And a good sort of catch-all way to play it. SLV, the iShares Silver Trust, is one way. It basically tracks the price of sort of like GLD, tracks the
Yep.
price of silver. It's up 24% year to date. There's a few stocks that have been recommended in Cabot Services, but I can't just give them
That's
away. But what I can do, this is a good segue to our offer today. Before we get to, we're going to talk about your tech takeaways from your European venture economic takeaways. We have our offer today is for Cabot Explorer, which is run by play the U.S.-China trade war, or to sort of avoid it, I guess. We're offering his Cabot Explorer service for today's listeners for 75% off the normal price. Uh, that is just $497 for the year. The normal price is just under 2000. If you go to cabotwealth.com/street, again, that's Cabot Explorer, where he is crushing it right now. Carl,
yeah,
as we talked about last week, he was very early on the money shifting from U.S. stocks, which have been overvalued for a while, and disproportionate amount of money compared to its percentage of GDP and population. The whole world is something like north of 70% of investment dollars are in have been in U.S. stocks, whereas U.S. GDP is what percentage GDP is like 30% or no less than that.
24,
What, 24?
24% maybe.
Okay, yeah. So he's called it the Great Rebalancing.
Yeah,
This is before tariffs, before Trump won presidency, um, money shifting overseas just because, investment dollars needed to go somewhere where and like to find value. And there's plenty of value in Europe. And we're seeing that with European stocks outperforming this year, Chinese stocks outperforming this year. Carl, we talked about last week, there are all these markets that are up north of 20%. It's like Poland, Italy, Greece, where you just were. And if this would be a good segue to you, there's also like Argentina, Chile, all those stocks are 20% or more up this year. And Carl has a bunch of international recommendations. That's a global stocks advisors, it has US stocks too, but by looking globally, Carl is crushing it this year. I don't think he has a single down stock in his portfolio. He has multiple stocks that have doubled. I think one or two of them tripled or more. So again, Cabot Explorer, we're offering it for a quarter of the normal price for today's listeners. Go to cabotwealth.com/street. Okay. So I just mentioned Greek market is crushing it this year. Did you see that when you went to Greece?
the people were incredibly welcoming. I did not see anything that screamed investing opportunity in Greece specifically.
They're
The
still not
poll,
paying their taxes there, right? I assume.
no, they're definitely paying their taxes. Um,
Well,
the
they do.
poll, the Poland thing stood out to me. That's one that I've been watching a lot because they're like the new growth hotspot in
Yeah.
Europe, at least from a GDP standpoint. I don't know that you can get exposure to Poland at all. From an investing standpoint, there
You
might be
gave
like,
out ETF, country ETFs. You keep vamping. I'll bring them up.
yeah. So I don't know where specifically. Like Poland, I think is getting a lot of some of the U.S. offshore worker bump for tech companies. They've got a couple like game developing companies that are very high profile relative to their economic size. The I'm going to transition to the thing that I had sort of intended with this, which was a really interesting, or what I thought was an interesting economic takeaway and a good reminder on like why to stay optimistic and why trade is good, global trade is good. We were on Crete for about a week. Crete had been like the hub of Minoan economic activity, you know, three 3000 BC, like 4000 BC to like 1800 BC. There's the palace at Knossos, which was a site that we went to. But one of the things that really stood out was when we were in their archaeological museum in Heraklion, the you could there was a high degree of like overlap with archaeological records that were economically based. So they used like sigils and stamps to denote what kind of tax they were collecting, right? So you have a little ring stamp and you put it in clay and it says, we collected this pottery from this trader and we're storing it. The amount of gold, silver jewelry, precious stones that were present in their archaeological collection for the same period as those economic markers, the trade markers, was like an overlapping Venn diagram. When those trade markers went away because of natural disasters and conquest and things like that, and there was no evidence of a lot of economic and trade activity, the cultural output was just essentially knockoff Greek pottery. You could literally see the importance of trade and economics on the cultural and artistic output of the people of Crete. Um, it is it's very easy to, in the abstract, try and like intellectualize away from the importance of economics and the importance of trade. I think especially for people on the left, right? Like if you're, I'm like, okay, well, capitalism isn't fair and capitalism is bad and it hurts people. We should all just be going out and creating art, and we should all be carving statues and writing poetry, like that kind of college level economic argument. It's easy to divorce the actual economic impact that weak trade or strong trade has on like artistic output and the ability of people to move up and down in society, right? Like economically, opportunity for improvement. I think if for people that might be listening that are inclined to say, well, capitalism and all this economic focus is a net negative, and we should really only be doing liberal arts stuff, or we should only be focusing on human welfare. You got to step back and you have to realize that the economic growth of this country, the economic growth of countries globally is intertwined inexorably in a way that you simply cannot remove. For us to have fair societies, for us to have economic mobility, upward mobility, we need a strong economic backdrop. Um,
Yeah.
and part of that, I think, should support the idea of being optimistic about trade, right? The trade policies that we're taking now are short-sighted. They're overly punishing, they're overly protectionist, and they will hamper economic mobility for people in this country, for people globally. The protectionism, it needs to, I'll say it needs to go. I can't do anything about it. Um, but I think there are people sort of on both sides of the aisle that discount the importance of trade or that are are going to push for what they ideologically believe in, while failing to acknowledge or failing to recognize that a strong economy that helps maybe not everybody equally, but that ultimately helps everybody is sort of the best path forward. We should be pursuing policies that promote abundance. You joked when I pitched this idea loosely that I must have read like Derek Thompson's book, which I have
All
not.
abundance. Yeah.
Yeah, it's called Abundance,
Yeah.
but like a strong economy is sort of foundational for us to achieve all of our goals, regardless of what side of the political aisle we're on. Um, I don't know. Sorry, I know that got a little bit rambly. I don't. It's it's not fully crystallized, but I hope it conveyed.
Yeah. I mean, we're seeing that play out the last few months. Most people realize that we need trading partners. We need, you know, flowing trade, which is why tariffs are so unpopular, at least in the investment world. It's why they've become a four-letter word. Um, and, I think this is why economists have all the dire projections that they have for what tariffs could do
Yeah.
to our economy and the global economy. Um, so, yeah, I think, you know, uh, Greece flourishing at a time when its trade was flowing is, that's no accident. By the way, I brought up the ETFs, country ETFs that Carl had cited. Greece is GREK, and Poland is EPOL, EPOL. Let me look at where
I
they
like
are. This was a couple weeks
I
ago.
like I like Poland over Greece, although I'm still too like what's the word I'm looking for? I'm overweighting the Greek default crisis of like 2011
Right, that's what I was
mentally
referring to them not paying
jaded.
their taxes.
Yeah, I'm too
Yeah,
jaded from that, even though it's like 15 years ago at this point. The thing I think ultimately that I was trying to get at with the Crete and the museums and seeing the archaeological record is just how visible the impact of trade is on society. Like it's a dividing line that's clear as day. And it's like here is where it was thriving: gold, gems, precious metals, silver. And then as soon as it stops thriving as a trade hub, you just have pottery. You have clay pottery in the style of the time, right? And some of the pottery work is great. Some of the stone relief work is great. But all these artisans, all these people whose jobs you would think would be disconnected sort of from the economic foundation
yeah,
of the island, they are not in a position to thrive either. So I guess it's maybe a little bit of pushback towards the doomsayers who I frequently count myself amongst. Like, right?
yeah,
Like the economics, all that's like all the evils of capitalism and all the bad stuff, all the exploitation of it. It's like, well, you can't just remove that bad part without even acknowledging that um, it helps pay for museums and it helps pay for statues and it helps pay for right like all of these other elements that even the doomsayers would promote.
yeah. And yeah, I'm the one who had the pessimistic take today, saying the market was going to pull back 5%. So, maybe you've come back from your European travels more optimistic, maybe.
Sure.
Yeah. Um, all right. Well, I have some kids to pick up from their final day of school. Today's my kid's last day of school. There's a tradition. So it's, you pick up from the school, everyone's honking, everyone's happy, and then everyone descends on this small local right off the road. I think it's technically a state highway. Ice cream shop. We call them creamies here. It's basically like frozen yogurt. It's really good though. And there's like 12 parking spots. So like it's a rush to you have to rush to get there and try and get one of those spots. You're not gonna get it. I'm not gonna get it. So just park on the road like half a mile away. But anyway, that's my fun little treat. You went to Europe. I've
You're
got
going to Creamies.
creamies with kids coming up in a few minutes. But happy Friday the 13th. I assume you're celebrating with you're a horror movie guy. You must be.
I am. My 12-year-old daughter and my wife and I watched all of the Friday the 13th movies in the last like 3 months or
Really?
maybe 6 months anyway.
Oh,
So I
you
don't know if
jumped
we're
the
gonna.
gun before today.
Oh yeah, the daughter was really into the horror stuff. So we're like, all right, we'll go back and we'll review some classics. I don't know if we'll watch one. Maybe we'll see.
Yeah, I don't think my kids are ready for any of it. So my oldest is 11, my son is 11, and he's like, I really want to start watching like, more mature movies, comedies though, no horror movies, please. He gets scared, which, he's his father's son.
Start them off with like Happy Gilmore and
Oh, he's
then
seen that one. Yeah,
Dumb
he's
and
into that Adam
Dumber,
Sandler stuff. Yeah.
Spaceballs, Mel
Done that.
Brooks.
Did that
All right,
recently. Yeah. Yeah, we're navigating.
Tommy Boy.
Did that too. Yeah.
All right,
Yeah, we are
doing
truly
good work as a
children of
dad.
the 90s. Well, good to have you back, and glad it was a good trip. And thanks everyone for joining us. And we'll be back next week.
Bye.